Alright, I'm reading out of the Reference Guide to Regulatory Compliance, and I'm in the section titled IRS Rules and Regulations. Not sure what this doesn't involve anything from Publication 590 regarding IRAs, so I might include that later. Publication 590, that is. What's here in the Reference Guide to Regulatory Compliance on page 761 is that the IRS has issued an increasing number of regulations over the past several years that require financial institutions to file various types of reports on the financial transactions of their customers. These regulations impose reporting requirements covering the interest earned by the financial institution on mortgage loans and student loans, interest paid to the depositor on deposit accounts, and property pledged to secure loans that is ultimately foreclosed on or abandoned. In 1996, the IRS issued final regulations that required banks to annually report borrowers whose debts are considered discharged. Although in 2007 the IRS temporarily allowed debt forgiven in connection with a debtor's principal dwelling to be exempt from information reporting, this exemption expired in 2012. Congress enacted the Foreign Account Tax Compliance Act FACTA in 2010. The IRS issued regulations to implement this law in 2013. The purpose of these is to require that U.S. citizens with foreign investments but receiving income on a U.S. source report and pay taxes. All citations refer to the Internal Revenue Code or the regulations. So, for mortgage interest reporting, the purpose is to allow the IRS to verify individual tax returns that claim mortgage interest deductions. What is covered is any interest recipient, a person in the course of trade or business receiving at least $600 of interest on a loan secured by real estate, including governmental units, cooperative housing corps, or servicers, which is the first person to receive the interest must report it. A person, so servicers are covered, and that would be the mortgager or person defined here to receive the interest payment first. A person does not have to be in the business of lending money to be covered. Foreign recipients are covered if the interest is collected within the United States. A person who collects interest on behalf of another, for example, a loan servicer, must file if the initial recipient received the information. An individual who lends money to buyers of his or her former personal residence is not required. And a person who owes $600 or more in interest during the year but does not actually pay at least $600 is not covered by the reporting requirement. Individuals who finance the purchase of their former principal residence or who take back a mortgage as a part of the sale do not have to report under this rule. If the person to receive interest on the loan does not have enough information to file a report, then the lender on whose behalf the interest is received is required to file. The payer being covered, the report must be in the name of the primary borrower or payer of record if there are multiple borrowers. Covered individuals only, not trust, partnerships, estates, associations, or corporations, and it includes sole proprietors. And the interest paid by foreign individuals must be reported if the real property is located in the United States. Now, I'm going back to B, cover individuals only, but not trusts, partnerships, estates, associations, or corps. I do want to mention here that this is going to require a W-9 to really determine that, because it's individuals, sole props, and if a partnership could be included here. perhaps even an association if it's not incorporated. But I can understand trust, estates, and corps certainly not covered. So interest covered does not include points, that is, although points paid on the purchase of a principal residence must be separately reported on a Form 1098. Easy, it's okay. Points also excluded are those to improve a principal residence, those to improve a second residence or a vacation home, or loans on investment property or business property, or home equity loans, refinances, or lines of credit, buy-downs, or loans with a principal in excess of $1 million. Those points are not reported. And further excluded is prepaid interest paid but not accrued, unless the interest received properly accrues in full by January 15th of the following year. Further not included is interest paid by the seller or a government agency, and should not be aggregated for multiple loans to the same borrower. As a safe harbor, the IRS considers any amount charged to the borrower that is expressed as a percentage of the loan as points. That's, again, points are any amount charged to the borrower that is expressed as a percentage of the loan. Got it. Mortgages covered are obligations made after 1987 that are secured by real property. This includes closed-end credit, lines of credit, and even credit card obligations. Real property also includes manufactured homes with a minimum living space of 400 square feet and a minimum width, oh my goodness, I just scrolled up way too fast, a minimum width on your manufactured home, right, of 102 inches, provided they are of a kind customarily used at a fixed location. Real property does not include boats, even if used as a principal residence. The mortgage insurance premiums, which are considered in Section 204 of the American Taxpayer Relief Act of 2012, extended the treatment of mortgage insurance premiums as qualified residence interest through December 31st of 2013, which is now over, so we're not considering mortgage insurance premiums to be interest in this case, and not considering it to be tax deductible, I suppose, or reportable by the bank. Reporting requirements under mortgage interest is the $600 reporting threshold applies on an obligation by obligation basis. There is no requirement to aggregate loans. Meaning if I have 6 loans all with interest of $101, the bank doesn't actually have to report that. The bank must file a report on IRS Form 1098 for interest exceeding $600 on any one loan and send to the IRS by February 28th of the year following the calendar year in which the interest is received, which is March 31st, if filing electronically. Contents on the Form 1098 is the name, address, and taxpayer ID number of the payer, the name, address, and tax ID number TIN of the interest recipient, and the amount of interest received on the mortgage, which includes prepayment penalties and late charges. Amount of points paid and whether the points are paid directly by the borrower as opposed to being withheld from the loan proceeds. The amount of interest other than points paid, reimbursements of interest, payer of record as is an individual, and any other information required on Form 1098. De minimis rule, interest properly accrued through January 15th of the next year may be reported if paid in the current calendar year. Because, why? mortgages paid in arrears. The statement to the borrower, IRC, which is Internal Revenue Code Section 1.6050H-2, the statement to the borrower must be sent on or before January 31st of the year following the calendar year in which the interest is received. It must be sent to the borrower's last known address, and it must include all information on the 1098 or a substitute statement that complies with applicable revenue procedures. A statement that the information is being reported to the IRS, notifying the payer that if payer is required to file a return, a negligence penalty may be imposed if the IRS determines that the payer underpaid tax because the mortgage deduction was overstated. A statement, I'm just rereading a statement that the information is being reported to the IRS, notifying the payer that if payer is required to file a return, a negligence penalty may be imposed if the IRS determines that the payer underpaid tax because the mortgage deduction was overstated. Like, that's what that's required to be in the statement to the borrower? I guess that's like some kind of special language. It has to be in the statement to the borrower. So, think about it as information to the borrower. It's a statement that the information is being reported to the IRS. Get it? And you notify the payer that if the payer is required to file a return, a negligence penalty would be assessed to the payer of the interest and can be imposed by the IRS if the IRS determines that the payer underpaid tax because the mortgage deduction was overstated. A statement that also included in the statement to the borrower is a statement that the amount reported is deductible only to the extent that the payer actually paid it and was not reimbursed by some other person. And a statement that the payer of record may be unable to deduct the full amount, and an instruction for any reimbursement that the amount is not to be deducted and must be included in gross income. Requesting TIN. A bank must request a TIN for all obligations incurred after 1987, the very end of 1987. The bank must take all reasonable steps to obtain a TIN at the time the obligation is incurred. If the bank does not obtain a TIN, it must request a TIN at least once annually until the customer responds. And that is in a separate mailing and must be on a form separate from other pieces inside of any other mailing. We must inform the payer that the TIN is required by the IRS to verify any mortgage interest deduction, and that payer is subject to a $50 penalty if a TIN is not provided. And I'm pretty sure that's actually assessed on the bank. Penalties. Failure to file information return. $100 penalty per return. $1.5 million maximum per year. However, if the failure is intentional, the penalty is $250 per return with no maximum if corrected within 30 days, or a $30 penalty per return with a $250,000 maximum per year. Right. If an unintentional error is made and corrected after 30 days on or before August 1st, then there will be a $60 penalty per the return, which is a maximum of $500,000 per year. There is a de minimis exception if the failure to file is corrected by August 1st and the failures to file include less than 0.5% of total returns filed. The failure to furnish a statement to the payer is $50 per return and a maximum of $100,000 per year. However, if it's intentional, there is no maximum per year, and there will be $250 assessed per return. The failure to report TINs to the IRS is $50 per return at a maximum of $250,000 per year. However, if it's intentional, they double that, and there's no max. For foreclosed and abandoned property, next.